Hi all. Today we will explore the mechanics of monetary policy, the process through which a country's central bank influences economic activity. Monetary policy is one of the most powerful tools available to governments and central banks for managing the economy. Its primary goal is to regulate aggregate demand, which is the total demand for goods and services within an economy. The central bank constantly monitors economic conditions such as inflation, unemployment, and economic growth. Based on these indicators, adjust monetary policy to either stimulate economic activity or slow it down. So as you can see the GOG here, policymakers aim to keep economy balanced around a zero neutral position. Okay. Neither overheating with excessive inflation or slowing down with the high unemployment. So here we will examine how monetary policy works, the tools used by central banks, and the effects of these decisions have on businesses, consumers, and economy as a whole. Okay. So let's start with the core levers of macroeconomic influence. Okay. To understand monetary policy, we first need to understand the main tools available to central banks. The first and most important tool is the interest rate. Okay. By raising or lowering interest rate, central bank influences borrowing and spending decisions throughout the economy. The second tool is money supply. Central bank can increase or decrease the amount of money circulating in the financial system, affecting the economic activity. And the third tool is the exchange rate. Changes in monetary policy can affect the value of a country's currency, influencing exports, uh, imports, and international trade. So the exchange rate. Okay. So the diagram illustrates these three levers feeding into the aggregate demand. Okay. So you can see how it is working on the aggregate demand. When policymakers adjust any of these levers, they directly impact the consumer spending, business investment, and overall economic growth. Together, these instruments allow central bank to steer the economic towards stability and sustainable growth. Okay. So now let's see the transmission pipeline. So here you can see how monetary policy decisions travel through the economy. Okay. So think of the central bank as the operator. Okay. So we have the central bank. It control the entire system, right? It began by adjusting the central interest rate. Okay. So it's all start with the central interest rate. Commercial bank act as the valve in the pipeline. So the mediator, right? Commercial bank. They respond to the central bank decision by changing the interest rate. They change borrowers and offer savers. Okay. So they will affect both depositors and loan takers, right? So next comes the flow stage, where consumers and businesses adjust their financial behavior. Lower interest rates generally encourage spending and borrowing, while higher interest rate encourages saving and reduce borrowing, right? So when the interest rate is less, they will take more borrowing, right? Borrowing will increase. And what if the interest rate is high? Saving will be more and borrowing will be less. Okay, clear? So these behavioral changes eventually reach the final stage, the aggregate demand curve. Increased spending and investment raise aggregate demand while reduced spending lowers it. Great. So this is how it will be affected. It will affect on the spending and borrowing. Right. And that is how aggregate demand is determined. So this process is known as the monetary transmission mechanism. So this is the monetary transmission mechanism. And it explains how a single policy decision can affect the entire economy. Got it? Now let's see the expansionary mode. So expansionary policy is typically used during periods of economic slowdown or recession. When economic activity is weak and unemployment is high, the central bank begins by cutting interest rate. Lower interest rate reduce the cost of borrowing for households and businesses. Commercial banks then lower their lending rates as borrowing becomes cheaper. Consumers are more likely to take loans for homes, cars, and other purchases. That is how it is usually happens, right? So when the interest rates are cut down or when the interest rates are lowered, the commercial banks will also drop their interest rate. For example, from 12 percentage of borrowing rate, they might reduce it to 9 percentage or 8 percentage, something like that. Just imagine. Okay. So what will happen now? More people will take loan for buying car, buying any other purchases or personal loans, housing loan, etc. Right? So people will take more loan. Businesses are also encouraged to borrow and invest in expansion projects. So, as spending and investment increases, aggregate demand rises, which will increase the aggregate demand, right? As a result, what will happen? This increased demand lead to firms to produce more goods and services, creating jobs and boosting economic growth. As a result, there will be an increase in employment and increase in growth. So what happened so far? First, interest rate is lowered. Okay, interest rate was lowered. As a result, borrowing increased. Okay. As a result, production increased. Okay. As a result, employment increased. So this will continue as a circle. Okay. As employment increases, more demand will be there, right? As demand increases, again the production will increase. So it will continue. The economy will grow. So therefore, the primary goal of expansionary monetary policy are to increase economic growth, reduce unemployment, and stimulate overall economic activity. Clear? So this is expansionary or expansionary monetary policy. Okay. So basically, we are using this on a recession period. So you know the business cycle, right? So there will be ups and downs, boom and recession, right? So when the economy is in recession, the government should involved, right? So the central bank should involve, government should involve. Government will be doing the things through fiscal policy, and the central bank will be doing changes through monetary policy. Okay. Now let's see the contractionary mode, just opposite the expansion. So this policy is usually implemented when inflation becomes too high and prices are rising rapidly. So what will happen at the time of inflation? If we have inflation, the prices will increase, right? So, to control inflation, the central bank raises the interest rate. Higher interest rate make borrowing more expensive and encourage saving. So here interest rate is increased. Okay, increasing interest rate. As a result, commercial bank also raises the interest rate, right? As a result, borrowing will decrease, saving will increase. So it will gradually reduce the aggregate demand and thereby reduce the inflation. Okay. So consumers reduce spending because loans become costlier, while businesses postpone investment due to higher financial cost, right? As spending and investment decline, aggregate demand falls. Lower demand reduces pressure on prices, helping to control inflation. The main objective of the contractionary monetary policy is to maintain price stability and prevent excessive inflation from damaging the economy. So excessive inflation is not good for the economy, right? So what happened here? Interest rate increased, borrowing decreased, right? As a result, people are not able to spend more, right? Savings increased and production have to be cut down because there is not much demand available now, right? Then also price will also comes down as the demand falls. Okay. So this is mostly implemented on boom period. Okay. Now let's see the monetary policy metrics. So the table summarizes the two major approaches to the monetary policy. Okay. On the left, you can see the recession, and on the right, you can see the inflation period. Okay. So here, primary action, cutting interest rate, right? During recession, we will cut the interest rate. Then commercial bank lower rates, right? Commercial bank also cuts. Then reduce unemployment and stimulate economic growth is their major objective. And during inflation, primary action will be interest rate increased by central bank. As a result, commercial bank will also increase their interest rate. The result will be reduce in price or inflation. Okay. So notice that both policies involve the same mechanism, interest rate, right, but are used in opposite direction depending on the economic situation. So central bank must carefully decide which approach is appropriate based on current economic conditions. Okay. So here let's see the balancing act performed by central banks. On one side, economy may face unemployment, stagnation, and weak growth. In such situations, expansionary monetary policy is used to stimulate demand and encourage economic activity. While on the other side, economy may experience excessive inflation, right? In this case, contractionary monetary policy is used to slow spending and stabilize prices. See, you can see both here, right? Both stages are visible. So the central bank constantly shift between these two approaches to maintain a macroeconomic equilibrium. Okay, that is a state where economic growth is sustainable, inflation is controlled, and employment remain high. So the key takeaway from this section is that monetary policy serves as a steering mechanism for the economy by influencing interest rate, money supply, and borrowing behavior. Central bank help maintain economic stability and support long-term prosperity. So monetary policy is not merely about changing interest rate, but it is a powerful economic management tool that influences spending, investment, employment, inflation and growth. Understanding how it works help us better understand how modern economies are guided towards stability and development. I hope it is clear for you. Thanks for watching.